Hello, my name is Briggeman, and I am a professor in the Department of Agricultural Economics at Kansas State University, and also the director of the Arthur Capper Cooperative Center. And I'm working here from my home office because of the COVID-19 pandemic, but I still have an extension program area that is certainly, I think, relevant today, in particular looking at the macroeconomy, interest rates, and what is the Federal Reserve's response to this COVID-19 pandemic. So I've prepared a few slides to just quickly go through some of these issues and talk about what is this response, what does it look like, what might it look like in the future, and then leave with a few questions for us to monitor going forward. So monetary policy tools are being used by the Fed to support the U.S. economy. One such tool is the federal funds rate. That is the primary interest rate that the Fed uses to send signals to the economy to try to bolster it or to try to cool it down. And clearly with this pandemic creating a lot of uncertainty and questions about growth, they have dropped it actually back to the zero bound. We have been at the zero bound before following the 2008 financial crisis. So we have returned there again, and again, trying to help stimulate and provide calm to the markets and the economy going forward. They've also started using quantitative easing again, or focusing on expanding their balance sheet. Now, this started actually again back in October 2019 when the Fed began to purchase $60 billion in U.S. Treasuries per month, trying to support the economy, get things moving forward, have an effect hopefully on the longer end of the yield curve to try and stimulate that borrowing and lending activity. But now they've committed again to ramp up by buying an additional $37 billion per month of U.S. Treasury. So we'll see further expansion of the balance sheet going forward. Also, they have committed to injecting $1.5 trillion into short-term funding markets. This is very similar to what they did in the 2008 financial crisis, where short-term lending credit was starting to seize up. The Fed provided different facilities to try to get that borrowing and lending, the asset markets, the credit markets to function. So we'll look at that here in a little bit on what it might look like with the balance sheet going forward. And then also they are creating lending facilities to support the flow of credit. So a commercial paper funding facility, a primary dealer credit funding facility, all aimed at meeting credit needs or to ensure credit needs of households and businesses are met going forward. Now, if we look at the effective Fed funds rate, like I said before, we've dropped down to the zero bound. So here you can see we're back to that. I went ahead and drew the line down just so we can see that it is going to shift going forward, that the effective Fed funds rate, the rate at which banks borrow and lend with each other in a very short-term market, has returned back to that zero bound. So we're going to see that, going forward with the Fed dropping that very quickly. Also, too, we can see the Fed's balance sheet and its evolution over time. Clearly, through the financial crisis, it expanded to nearly $4.5 trillion. But around 2018, the Fed started to unwind the balance sheet, letting those securities mature and not repurchasing them. And that actually stopped in October 2019 when the Fed committed to purchasing $60 billion in U.S. Treasuries. So that is why you can see the circle area here. It has grown back to about that $4.5 trillion mark. Now, what is it going to look like when the $1.5 trillion gets pushed into the Fed's balance sheet through those short-term lending markets? Well, all we have to do is actually look at the different facilities the Fed created in the financial crisis to have an idea of what that might look like. So this green and purple area, you can see that real sharp up of about $1.5 trillion. So we would expect the Fed's balance sheet to very rapidly expand to right around $6 trillion. But the thing to notice is that that tapered off pretty quickly. That green and purple area, as credit markets begin to function better, it would go away. So that would be at least how I would project it going forward. Hopefully we can move through that very quickly and let those different facilities expire, so then the Fed's balance sheet can return back down to that $4.5 trillion. One thing also to note about this quantitative easing and this amount, this $4.5 trillion that's sitting there. These funds are not going to enter into the commercial banking fractional reserve system, and that would, if it did, that could be very negative for inflation. We could see a lot of rapid inflation, but I must repeat that when we look at this is aimed primarily at asset markets and credit markets. It will not enter into that. So enter into the commercial banking system. So we can see as that begins to unwind. Hopefully we can begin to see this unwind again, like we had in 2018, because that would be a signal of us moving through some very disruptive times. So what are some key questions going forward? Questions that I get asked when I'm out working with audiences, and obviously I'm working from home, so I don't have that luxury right now. Will interest rates go lower? I know a lot of farmers that I've talked to, agribusinesses, with the Fed expanding the balance sheet and starting to see interest rates come down late 2019 and even here in early 2020. We've seen that an opportunity to fix those lower interest rates. Could they go lower? They're pretty low right now. Not sure, it's unclear about how they'll evolve going forward, but maybe looking at your own operation, does it make sense to lock in some of those lower rates? And that's on a very one-to-one basis. Will the Fed's response calm domestic, global markets? Hopefully it will, here in the near future, that we can begin to see that calming. I know right now, looking at the stock market, it's kind of this whipsaw effect of it's really bad and then it's positive and it's going back and forth. So we're right in the middle of it right now. So we need to hopefully see some calming of that. The questions of, will we enter into a recession? We've been in the longest period of growth the U.S. economy has ever seen on a month or quarter basis. So naturally you would expect at some point we'll hit the downside of the business cycle. Maybe this accelerates it. I know it certainly increases the chances we could move into recession. It'll be interesting to see how consumption numbers come in. Certainly that's a huge part of the U.S. economy. So when we are sitting at home, we're not out purchasing and consuming goods, that can be very negative to our economy. So how is that going to, likely going to pull down? Will it pull it down enough that we actually see the contraction of GDP for 2 consecutive quarters? It's certainly a possibility. It has raised the likelihood of that happening. And then finally, what does this mean for agriculture? We're just moving into a new season here in 2020. It's for keys that I would tell, farmers and agribusinesses is to focus on the balance sheet, control your costs, be mindful of those expansion opportunities, build up working capital and liquidity the best that you can, because in an uncertain environment like we're moving into, that's some of the key things that you need to do. We'll certainly have to monitor this going forward. So I will come back, potentially give another update as we get more information, but we're right at the start and wanted to get this video out there. If you need to contact me, feel free to drop me an email at bbrigg@ksu.edu or look me up on the web. Take care.